welcome to the podcast, everybody. Thank you for joining me. Here we are on Thursday, December 13th. The stock market is closed, as you can see, pretty nasty across the board. Really, the only one exception there is the transports. Transports were up on the day modestly. I'm going to go through a few different sectors today through this, but for the most part, of course, we had the Fed decision yesterday, and which we'll get to in just a minute. And interest rates were up 1.72%, so they've had a turnaround. So all the bond bulls have been hurt the last couple of days. Volatility was up and starting to perk up a little bit. People having a little fear coming in here as some of the, fiscal cliff talks don't seem to be going anywhere right now. But let's go ahead and start with the Dow. And this is a two-day picture of the Dow. And the reason I'm showing this is, of course, we had the Fed decision yesterday, came right about here. And the Fed announced that, yes, they're going to keep interest rates low. And as opposed to saying 2015 like they had in the past or for an extended period of time, they basically took one of the Fed presidents, Evans, they took his recommendation to target inflation and unemployment. So essentially what they said was we're going to keep interest rates low as long as unemployment's above 6.5% and as long as inflation's below 2.5%. In addition, we're going to be buying about $45 billion a month of treasuries. And they're already buying mortgage bonds at, I think, $40 billion a month. So you're talking $85 billion a month. You can call it QE 3.5, QE 4, but definitely more stimulus. And so the market initially reacted on this, pop. Then Ben Bernanke's press conference came afterwards, which is something new they're doing in the last, couple of years here. And, he talked about the fiscal cliff odds, I guess, and I actually didn't get to see the press conference, but the market sold off on that. And it was looking as if it was going to be a buy the rumor, sell the news, really, regardless of what happened, and that's exactly what we saw. We talked about on the podcast 2 days ago the fact that the market in the very short term was getting overbought, and that was just as one of these pendulum, these different oscillators we watch and kind of the momentum and so forth was getting to a point where things were getting a little overdone to the upside. Remember, it got overdone to the downside, and we said at that point, if you had some things to sell, don't do it. You would probably have higher prices. We had those higher prices. Now here we are, and the market was on the other side. Wasn't extremely overbought, but definitely needed at least a pause. And what we got yesterday was, after the initial jump, we got that. This is where the market closed on the day. And then it opened this morning, and it was pretty much down all day. A little short covering here at the end of the day, but for the most part, down across the board. And today was one of those days where breadth was pretty bad, meaning a lot of different things across the board went down. If you open your portfolio and you have 50 different positions, probably 45 of them were down on the day. That's what we mean by breadth. And so it's pretty nasty day overall. I think we're seeing, every day now it seems like Boehner's giving a press conference or a speech, Harry Reid, and whenever they open their mouths, we have a volatility alert. Things start to go haywire one way or the other, right? Depending on what they say or what word they use, the markets try to discount what does that mean. And as I've said before in this podcast, there are several reasons why I think this thing's going to go down to the wire, if not over. There's a very good chance it goes over the cliff, technically, and we go into January 1st. Few reasons, again, and I'll recap, because people, the constituents and the caucus, they want to see that these people are really fighting for their side. And by doing a deal in early December, did you really negotiate as hard as you could have? So they want to go all the way down to the wire to show that, hey, they really did this. They really negotiated as hard as they could, and they did everything they could, but at the end of the day, they had to compromise. Otherwise, things would just be horrible for the economy and the stock market and whatever. That's why it could go longer. Secondly, as we know, interest rates are going to, and taxes, are going to pop up at January 1st by default as the Bush tax cuts sunset. So if they do cut taxes at that point, even if they were higher than today's rates, they are on record as showing that they are cutting taxes, not raising taxes. That's another reason. And thirdly, because they're trying to negotiate, and both sides are trying to do what they think is right and push for what they think is the right thing to do, and this is how negotiations go. in the meantime, the closer we get to this deadline, the stock market is starting to get a little bit nervous, which it should be. You can see the Dow in the last few days here. Here's that oversold condition we talked about, and now we're at a point where you see these lines mean that it didn't close at its high of the day. In fact, yesterday you can see it closed or 2 days ago in the middle range here. We'll zoom in a little bit, and then yesterday gave up all the gains and finished flat to down a little bit on the day, and then today, of course, down. So all these lines here telling you that we're not going out on the highs of the day, and that's a problem, showing you the market may be getting a little tired. So we have a market that was ripe for some type of pullback, and again, in the big picture, things in the stock market right now, when you look at like we have talked about, the supply and demand, medium term, you've taken the fiscal cliff discussions out of the picture. Technically, it still looks okay. Yes, we were probably due for some type of little pullback in the very short run, as I talked about. Perhaps coming down to this 200-day moving average on the Dow Jones would be perfectly logical, and then up again. Fantastic. We'll go over to the S&P 500, and you can see it's kind of the same thing. Today, what we saw was kind of a convergence of the 100-day moving average, the 50-day moving average, and the 10-day moving average are all right at this spot, and it held at that spot. So, if you're bullish, this is what you're hoping for, is it can hang on there and just move sideways and then maybe ramp up again. And we may have that, but we're going to have a lot of volatility. And if you're nervous about the fiscal cliff and you've made some money over the last 2-3 weeks, taking some off the table is logical. Again, you have to decide if things go poorly, which there's a 50-50 chance they do as far as the fiscal cliff is concerned. Do I want to be in the market or do I want to be out? And again, as I told you the other day, I am playing the middle. I have a hefty amount of cash, but I also have some positions. One thing that I did sell today, and I know a lot of you have been asking about, emailing about, and so forth, is utilities. Utilities, of course, right after the election got hit very hard because of the fact that dividends are going to be taxed higher. We don't know what the rate's going to be, but the market doesn't care. It says we're going to sell now and figure it out later. So we got this big sell-off, right? And as this sell-off came, the utilities, which I've had for probably 2.5 years now, so it's been kind of a core holding. It's been a great long-term move, and it's paid 4 to 4.5% a year, plus a lot of appreciation over the last couple of years. But we've definitely had this breakdown, and so once it got down to this level, I talked about the fact, I think it was the Wednesday before Thanksgiving, that it looked like a capitulation day. And what that meant was a day where that went way down and then it reversed and it really came off its lows. We saw it do that. I think it was right here. And then it went down one more day. Then we had a big, strong day on, I guess that was Monday after the Thanksgiving holiday. And it's been up ever since. So the logical thing was, and my plan going into this was, we're going to let this thing run, but it looks broken to me, and when it gets up to somewhere around its 200-day moving average, or at least breaks this uptrend, that will be the time we sell. And so we actually did sell this today and took those profits that we've had for the last 2.5 years, I think. So not only have we received appreciation, and you can see a long-term picture, this bull market that utilities have been in, not only have we seen that, but we've also been seeing the 4.5% per year. By the way, by the time you hear this or watch this, I think John Boehner and President Obama are supposed to speak either together or in public or do something. Who knows what? But again, it could be something market moving for tomorrow. But going back to 2010, which is when I first bought utilities for the first time, there have been a couple of sell-offs. Of course, during the May flash crash summer, which was a 2-month sell-off, utilities had a tough time in there. And then, of course, last summer, when we went through the debt situation and our debt was downgraded, went through that. This time, it could be no different. This could just be a blip on the map, and a lot of long-term bulls would say, look, this is your line in the sand right here, and it hasn't broken that. It's still in this uptrend. I hear what you're saying, and I do think that, fundamentally, it does make sense to still own utilities. It's something we all need. It pays a nice dividend. It's stable. It's not cyclical. However, we have to look what's happening in the fact that they've been underperforming. They are may have some regulation challenges after Sandy and so forth, and the dividend tax could go much higher, and we already know it's going to go up. So I think once it broke the 200, it told you something's changed here. So now what we're looking for is, is it going to start a new downtrend? And I think there's a high possibility of that. So, it had this zigzag pattern, came down, we let it bounce, and now it looks like it could roll over and head back down. That's what I'm fearful of, which is why I went ahead and exited that. It was a big position. It's probably one of my biggest positions, and so that's something that I am out of right now. For people that look for income, I think there's other ways to find, better income than utilities, but I do think it's been something that has been somewhat of a core position to some degree, and I'm out of it now. I would love to get back into it because I think it makes sense in the in the long term here, given this kind of stagnant economy and given that it does have a nice yield. But there are plenty of other things that have that type of yield. So utilities right now are off my radar for the time being, and something that I did take profits on today. So we'll run through a few of these. Here's the S&P 500, and as you can see, kind of the same as the Dow Jones. Had a nice run. Today was kind of phase one of your selling. You take off maybe a couple of those things that you had bought down when things were panicky. You take those off and to say, okay, I'm going to lock in profits on those things maybe, but I'm not getting real serious about selling and getting real aggressive just yet on the first day of selling. So that was phase one. You can see gold in here, which I'm not really trading. I have a small position in gold that's more of a long-term core position. Gold's kind of meandering around. Really, I think people in gold and people that trade gold don't really know what to think of gold, because while we're seeing deflation in some areas, right? The PPI came out today lower or better than expected, I guess. Bigger drop. You're seeing energy prices go down, deflation, but you're seeing inflation in other areas, right? Healthcare and places like that. Overall, the general consensus is there's deflation in the short term, not inflation. So gold should go down. However, we know that there's money printing all over the world. We just saw it here at home yesterday to a huge extent, and it's going to continue. So as long as that continues, gold remains in a bull market. But I have heard even some bulls say, hey, it's short term, the next 2-3 weeks, gold may be under some pressure, but ultimately, 2013, we're going to break on up to those old highs, 1740, 1750, and then blast on through. So again, if you have a small position as kind of something that is not correlated to your other stuff, I think it makes perfect sense. If you're trading it, I don't really see an edge here from a short-term trading perspective at all. So I would simply wait if you're looking for gold as a trade. Technology stocks stuck right here, right at their 200-day moving average. This is XLK, which is an ETF, surrogate ETF for technology. See it, fell on through and came and tried to get back to it, having trouble here. So if it breaks above that, fantastic. You can see these short-term moving averages are heading up. So if it kind of does this deal, then great. That would be what we would want. But technology right now, kind of a mixed bag. There are some stocks that look good, but kind of interesting when you look at stocks like First Solar leading the way up, Research in Motion leading the way up, and Netflix leading the way up. That tells you that, and Yahoo, by the way, leading the way up. This is probably not the four horsemen that we would think would be leading the market higher, and so kind of interesting that those are your winners in the last couple of months. And unfortunately, I don't own any of those. I own bonds on one of those. I don't own any of these individual stocks. We talked about interest rates, and you can see TLT here had kind of had this wedge pattern. It broke out. It looked like the bond bulls were back in charge, and now it's breaking down the last couple of days. Now, interest rates were much higher today, and then we saw a reversal. Once the stock market sold off, some money did come back into bonds, but generally speaking, the last few days, bonds had been down. So they're kind of hovering around this 200-day moving average. Again, kind of at an inflection point where either they may break down or could turn right back around. I think, again, from the perspective of they're going to do more money printing and keep rates low for a long time, treasuries look like they're still safe for right now. At some point, this bubble will burst, but it doesn't look like it's right around the corner. In fact, probably some of the worst calls of the year by some of the pundits has been shorting treasuries, and that's probably been the consistent worst call of the year the last 3 or 4 years, because everybody thought rates were going to rise at some point. I do too, and I would have thought it would have been by now, but it's not. And the Fed just told you yesterday, instead of a time frame, these are the things to look for. They're telling you what the formula is when they're going to raise rates. Now, again, they can't control, to a certain extent, long-term rates. They're talking about short-term rates. But when they go in and buy $45 billion a month of treasuries, yes, that does affect long-term rates as well. But there may be a day where the selling overwhelms them and interest rates do go up. So don't just think because they said that hey, I'm free to go, bet the farm on rates going down. But for the time being, it doesn't look like they're going to race up tomorrow. I tweeted about healthcare today. I think healthcare has been a nice sector. It had a sell-off, of course, in October, November when everything else did. Rallied back up, and now you've kind of got this not only double top, triple top, and there's some exhaustion indicators that I watched that look like healthcare could reverse. You look at it on a day like today and go, well, it's only down 85 basis points, kind of in line with the overall market. Well, the industrials were down 0.5%. The Russell 2000, 0.2%. Financials down 0.5%. The S&P 500, 0.2%. So healthcare underperformed today, not by a bunch, but enough. And I just think that's one sector to keep an eye on because it had been doing very well, has a yield of 2%. It's, there's certain areas that are benefiting from Obamacare in here. But in general, it's been kind of a safe haven. And you've seen in the last few weeks some of the safe havens, utilities, and healthcare have been struggling, at least, from October until the election and so forth until now. Emerging markets, this has been a bright spot. This is an area that has been very strong, and partially because China is obviously included in here, but this is a really an area that nobody talks about, and it's kind of like, hey, if we're struggling and Europe's struggling, there's no way the emerging markets can be doing well because they're kind of the end of the tail on the dog, right? If we're slowing down, they must really be slowing down. But they've already taken a big hit, and you can see it's breaking out here, and the short run pulled back today. But here, if we zoom out a little bit, you can see what's really going on since 2008, the heyday. Since that time, it's recovered, but it's still off 15-20% from its high. So, emerging markets has some catching up to do. So keep an eye on emerging markets because, again, and even this is a weekly picture now, but you can see it's kind of been, just may have broken out of this little pennant here at the very end. So it could just be getting started. If we get a further pullback, then that may be a good time to make an entry into emerging markets, which we haven't looked at in quite a while. So global growth has kind of been off the table, but now, at least for a trade, it may be back on the table. So keep an eye on emerging markets. Financials, I own financials. They've been acting pretty well. We're coming up to an area where it could be toppy here, so we're watching that. Probably looking to adjust out of those sometime at the end of the month. But keep an eye on financials as well. But they've been very strong, especially companies like Bank of America up near a high, which is obviously in there. Goldman Sachs, kind of near a high, and then Citigroup, of course, has been having some structural changes, and you can see they're near a high as well. So financials have been hanging in there. They're only down 0.5% today, even though some of the other areas in the market were down even more, like semiconductors or technology in general. So that's a wrap for today. Just wanted to go through a few sectors, tell you what I'm looking at. Overall, the market's still overbought even after today. May not be anything major, but today was round one of make sure if for the things that you really want to trade quickly, do you have your stops in? Do you know where you're going to sell these things and so forth? And then phase two would be, okay, do I need to get more defensive as we get closer to the fiscal cliff? So today was just phase one, just a wake-up call and taking some profits on some of these things that had run up from the lows a couple of weeks ago. Hey, twitter.com/Karl Eggers, Google+, Facebook, through-a-traderseyes.com, karleggers.com, and also eggerscapital.com as well for the money management site. Take care, everybody. Have a wonderful evening.